Well, Hunter, it's 2026. Happy New Year. We're looking forward to contributing more to our listeners as far as research, our thoughts, and everything that's going on with markets. But because it is a new year, you know what that means. It's time for our 2026 outlook. And for anyone who's interested in reading more, you can find our 2026 outlook on our website at beckcapitalmanagement.com. But what I want to do is in this next series, and we're going to split this into 3 podcasts, is really go over our 26 outlook, what we think is going to go on with markets, the major themes that we are following, and then the sectors we're investing in and why we are investing. Generally, we're tilting bullish this year. We feel optimistic about the markets, but we really want to dive into why we feel that way, what areas are we looking at, and what's going to be driving our investment philosophy in this year to come. So I'm excited to go over that with you.
Yeah, I'm excited to take a look at it. It's some new stuff, some old stuff. We don't try and bury the lead. We've been talking about a lot of these things for a while, but taking a fresh look at it and revisiting old stuff, obviously, and then sprinkling in some new stuff along with our expectations for the year to come.
Yeah, and so the way that we're going to break this down is in this first podcast, we're going to cover our major megatrend for the year, and that continues to be the AI supercycle and all of the picks and shovels and things that come along with the AI ecosystem. It goes far beyond technology, as we've mentioned in podcasts before. And then in our second podcast, we'll go over the macro backdrop, what's going on with the Fed, some policy decisions, and how that's going to drive the market forward in 2026. And then finally, we're going to talk about a little bit more of the micro, how we're going to see some earnings growth, what's going to contribute as far as buybacks and regulatory changes that's going to impact on the company level, and then really dive into some of the sectors that we're watching beyond the AI ecosystem. So we're going to kind of split it up those ways. And today we're excited to talk about that number one megatrend, and that continues to be AI.
Yeah, no, AI is huge, has been huge, remains that way. Whenever you have hundreds of billions of dollars going into one segment of the market, there's going to be something to invest around there, even if you're not buying your most high-flying, speculative, maybe non-profitable companies out there. There are always many layers of people making money when others are spending hundreds of billions of dollars. But before we really dive into that, it wouldn't be a year outlook podcast or newsletter without revisiting our expectations for 2025 and seeing how we stacked up against those.
Right. I think, we always enjoy giving ourselves, kind of a grade on our, yearly outlooks. Hey, what developed over the year? What was in line with what we expected, and what kind of surprised us, or did we not really expect as written in our outlook? And a few things that I think are pertinent to look at, some things that we did get right were that, it was a strong market where AI really remained the focus. I mean, we had some hiccups here and there. We had the DeepSeek moment. We had some times when the AI trade as a whole pulled back to an extent. But for the most part, earnings growth, just the macro story, really driven by artificial intelligence. Secondly, we saw just the broad market was not inhibited by valuations. We've done podcasts and research on this before, but when everyone was going into the year, the market's trading at 22 times forward earnings, and people are saying things are really expensive, maybe expect lower returns. We weren't as concerned about the valuation aspect. And what we saw last year was a combination of mostly returns driven by earnings growth, which is what you always want to see, but also still some mild multiple expansion. So the market entered the year around 22 times, it exited the year around 23 times, which helped support those returns that we saw. And of course, we had pretty good years for the S&P and for the NASDAQ. But those were a couple of things that we also kind of expected, and it really played out throughout the course of the year that those valuations didn't provide a headwind. And then finally, something that also kind of came under our expectations were Fed cuts. They pretty much fell in line with what we were expecting. Kind of that we're kind of expecting that 2-3 cut range, and most of those, of course, came at the very end of the year. But pretty much followed expectations. The Fed, of course, provided some volatility to markets at that meeting on a meeting-to-meeting basis. but followed a pretty transparent framework as far as, they're forecasting their moves. The market wasn't ever caught too off sides as far as Fed action. So that kind of went the way that we were expecting.
Yeah, exactly. And revisiting the valuations for a moment, for reference, the S&P returned about 16.5% last year, the NASDAQ a little over 20%. And so to only have an increase from 22 to 23 times on the S&P of forward earnings and still have such good growth, that shows you that the vast majority of that was based on earnings growth, which is really healthy. And, like you said, as we'll get into, we're expecting more of the same this year. And I think the backdrop for that is setting up really well going into 2026. And then moving back to things that we got right and then incorrect, were the sector calls that we made at the beginning of the year. We highlighted a few sectors: tech, obviously, for the AI trade, industrials, utilities, also kind of more picks and shovels portions of that, but also, with their own drivers within those sectors, as well as financials. And all of those were in the top half of sectors last year. And so, those being our, kind of key sectors, it was nice to see all of those performing well last year.
Completely agree. And the good thing about last year was the market kind of followed the playbook for the most part. Of course, there were some surprises. There always are when you're talking about financial markets. And I think it's critical to note whenever you're talking about planning or forecasts or outlooks, it's, I go back to the quote by Eisenhower saying, plans are useless, but planning is indispensable. So it's one of those things where, no analyst is going to get everything perfectly right, but being prepared and having an analysis going in sets you up better than just saying, hey, I don't know what to expect this year, so I'm not going to make a call. But one of those unexpected events was certainly the tariffs. When those were first initiated in April, I think that caught all of Wall Street really off guard. And then we saw those kind of take the form of what everyone was initially expecting, more targeted, less sweeping, not as severe as they were first instituted. And so the end game for tariffs became something that was, much healthier from a market appetite and really didn't influence the broader macro picture too dramatically. And then, and this is completely separate, but the other surprise was, we didn't see crypto perform quite as well as we were anticipating. The use cases continued to, improve and continue to push into the market. So we had more and more institutional players involved in the crypto sphere, creating, programs and, bringing traditional finance more onto the blockchain. But the coins and the cryptocurrencies themselves didn't perform quite to expectations. So it kind of a, half and half on that one right there.
Yeah, I'd say that's a little disappointing from the price performance perspective, but looking at the underlying economy of crypto and what's, like you said, what's being built on there, what people are using it for, just the broad applications. You're seeing even people like JP Morgan, who's been in the crypto realm for a while, even though they don't like to admit it or say so. They've been using crypto internally for a long time. And the past year we've seen that, kind of take steps forward and actually some, almost positive remarks from Jamie Dimon about crypto, which was, a little bit shocking, honestly. But it's great to see all of that foundation being built for, perhaps some growth in the coming in the future.
Exactly. Well, now that we've kind of gotten through our 2025 recap, and if for any of our listeners, if you have questions about 2025, what we wrote, please reach out to us. We're more than happy to answer and share our thoughts. But let's get into 2026. This is a year to come. This is what we're excited about. And of course, the driving megatrend for our investment thesis for a lot of what we are investing in on the equity side is artificial intelligence and the super cycle that continues. And you've heard more and more people talking about, well, is AI in a bubble? Where are we in the stage of the AI race or the AI game? And we still believe that we're relatively early. I mean, we're certainly in the early towards early middle innings of the AI race. And a lot of that's driven because of the CapEx spend that we see these major hyperscalers, these giant AI companies, their forward guidance that they're issuing. They're spending even more over a huge 2025. They anticipate spending much more in 2026. So all of the industries and organizations that benefit from that CapEx spend are set to benefit again in 2026.
And going off of that, Victor, I think it's really important to call out that, versus what we might see in a traditional bubble stage is most of the money being poured into AI, hundreds of billions of dollars, is all being financed through free cash flows of these companies. It's not debt driven. It's not equity issuance driven. In fact, a lot of these companies are buying back their own stock while pouring a bunch of money into AI. So all of these companies have either traditional business lines that can pay for it or customers lined up with traditional business lines that can pay for it. It's really a self-funded investment. So it's hard for that to really get out of control necessarily, like into bubble territory, like we've seen in history, throughout history. Whenever you run into problems, it's generally when people get over levered or out in front of their skis. And what we're seeing is a bunch of companies spending heavily in something they believe in, however, doing it still in a financially literate way, at least.
Yeah, I think you make a great point. And we will have to distinguish on a company by company basis because
Absolutely.
there are certain cases where we are avoiding companies because they're taking on too much debt. But generally, and I thought the stat was very interesting comparing AI now to the dot-com bubble, and that being that only 25% of revenue are current AI CapEx budgets. So let me say that again, is that of the revenue that these companies are generating, 25% is being spent on AI infrastructure. Now that's much, much less. Now it's not nothing. I mean, that's still a pretty large percentage, especially of revenue. We're not talking about, your profitability, but it is much lower than when you compare 400% of revenue was being spent in CapEx during the dot-com bubble. So if you're going to compare bubbles or try to call AI a potential bubble, you're not way out over your skis. Of course, there are some companies that are loading up on debt, but for the most part, you are within a range that is, palatable from an investment perspective. So I think that's really important to know. And I really liked seeing that data point as far as a contrast back to .com.
Yeah, and I think kind of to that point, trying not to get too off topic here, that's another reason that, as we'll say in the future, I think we're getting back into more stock picker territory because we start to see a lot more, differences in unique financial situations, product lines, just whatever it is, differentiations appear in these companies. And it's not really one AI, like coherent AI ecosystem. It's a whole bunch of individual companies playing along in there. And so that makes it a lot more interesting, at least from my perspective, because, there's more work to be done analyzing those companies and, kind of taking a look under the surface level of really like what they're doing, the broad headlines and everything.
Yeah, I completely agree. And I think that's what's interesting about investing in AI this year is that the AI narrative is somewhat fractured. It is not all of these companies are up and to the right with a beta of one. It is, hey, you have to pick the companies that are going to be best positioned within artificial intelligence and who's going to be profitable, who's cash flow generative, because you can't just invest in everything anymore. More so in late 23, 24, early 25, you could kind of throw darts at an AI company board, and you probably would have been just fine. But I think that's going to be less and less true as time goes on. And we've already seen that start to happen, especially in late 25, differentiating the companies that are going to be generating new revenue, generating cash flow, creating profitability from their AI applications. And that goes into, one of our major points is that AI this year isn't going to be just talking about LLMs, about large language models like your ChatGPT, like your Gemini. Of course, those will be included in the conversation, but we're also going to be talking about other AI applications, robotics, autonomous driving, biomedical research, things like that are going to create huge profitability centers for these AI companies that aren't just your consumer facing, very obvious trend like we've seen in the last couple of years.
Yeah, exactly. Which I think really brings us into the second big point about AI in 2026 that we're expecting is that we're starting to see monetization of these, whether it is large language models or any of the litany of other applications that AI has, is that companies are starting to see a return on their investment. It's hard to continue pouring hundreds of billions of dollars into something without realizing some return, even though it's not a profitable venture yet. You're starting to see companies play around with whether it's shopping within large language models, maybe some version of ad support. A lot of it is behind the scenes as far as business to business, company specific large language models or that self-driving robotics, industry warehouse robotics are a huge thing nowadays, especially with the kind of what I've been calling the repatriatization of manufacturing. If we're bringing manufacturing back to America, we have something, that it makes it difficult, and that's high labor costs. And so how do you combat that? What's been America's, economic advantage over a lot of countries? It's our productivity and our ability to, apply technology in a way that other people don't. And so that in this case, in a lot of these cases, that's robotics, that's autonomy, making things happen without throwing so many labor hours at it. And so seeing this monetization come into play has been really exciting because it shows these AI applications really having a self-propelling economy behind them.
Yeah, and I think this is the kind of the first year that we are also really looking at the companies that are benefiting from AI software, from AI applications, who's going to be able to increase their margins because they're implementing AI. There were, 24, 25, you're just kind of figuring out how to use it, how to implement it into your business. And now you're seeing companies who are generating greater revenue, greater profitability from putting AI into their business. And so now looking at those companies is also interesting from a monetization aspect. Now, when it comes to how we think about investing in AI, we continue to look at the picks and shovels. And no place is this really more obvious than the power generation needs that are created by data center infrastructure. Now, we are way behind on power, and the data and the data center power outlay that is going to be needed over the next 5, 10, 15 years is enormous. You've got companies working with utilities, 5 years into the future for electricity demand, and you're contracting power, upwards of 15 years in order to make sure your data center can run, appropriately 24/7 around the clock. And so this is a huge segment of this AI business, whenever you're not talking about the hyperscalers, when you're not talking about the semiconductor companies like NVIDIA, who's being able to generate the power, convert that power, and provide it to those data centers is a huge area where we're focused on. And I think kind of breaking down some of the new sources for power is also interesting. So I'd like to start there. And of course, we're certainly looking at nuclear being a new one on the block, natural gas, and then, your alternative forms of power. But especially those first two, I think, are interesting to break down.
Yeah, it's been interesting to watch the kind of picks and shovels mentality that we've had into AI for a long time. Started with specifically on the GPUs, the hardware that's going into these data centers. And you've really seen it trickle downstream to find the bottleneck because, people are producing GPUs. People are finding places to put data centers, but then trying to find the land, the GPUs, the racks, all of that. A lot of that's been figured out, but a lot of that, it goes downstream. Where's the power? How do I get hooked up to the grid and actually make sure this thing can run? Because building a huge building with a whole bunch of hardware in it doesn't do you any good if you can't power that hardware.
Right.
And so a lot of that's trickled down to the power demand. We've heard a ton about small modular reactors or SMRs over the past few years. Those are really interesting, really exciting. Those are tough because you're not going to see any, at least in the US, get turned on until 2028, probably at the earliest. And then you're even just talking about kind of testing units, the whole argument behind SMRs, or not whole argument, but a lot of the argument about them hinges on their modularity. It's we can produce these basically on a factory line and drive down costs a whole bunch because we can just mass produce these things. Well, whenever you're starting that up, you can't mass produce them. You're producing one here, two there. And so you're not really realizing a lot of cost savings. And so it's not until that ramps up that I'm expecting those to deliver a considerable amount of power to the grid. And so that's probably in the early 2030s by that point. Personal take, but that's kind of how I see the market. Where you have traditional large scale nuclear, that's really interesting because a lot of those you can just turn right back on because there have been a lot of shutdowns, but not full decommissions or destructions of these nuclear plants. And so we're seeing a lot of nuclear facilities get turned back online. And so you're talking about a gigawatt, just, not quite that, but in a matter of months instead of years or decades, like some of these can take to build. But that's also falls under a same kind of constraint or issue that small modular reactors do, is just kind of a lead time issue, because we used to, in the 70s, particularly 70s, 80s, we're producing dozens of nuclear reactors. People knew how to build them. We had a workforce that was trained to do this. We haven't produced more than a few nuclear reactors in the past 30 years. So having a lack of skilled people who can do that is why they're taking 10, 12 years to build. And so if we can kind of get that economy rolling again, we can start pumping them out like we used to, like China is currently. But until we kind of kickstart that, it's going to be tough to produce new ones outside of the restarts that we're seeing. But all of that is still really encouraging to me for our good baseload power into really starting in about 2030. We can see a lot of that start to come online. And without getting into capacity factors or anything like that, nuclear reactors run 24/7 with very little downtime. So they make a great baseload power demand for the grid, because that's what these data centers need, is 24/7, 365-day power. They can't turn on, turn off because it's just far too expensive.
Yeah, I think nuclear is a great solution for what AI is looking for, especially what you just mentioned, 24/7, capabilities. And it's interesting because I've heard it referred to as a little bit of a reverse learning curve, because we learned how to do all these things, like you said, in the 70s. And then, we kind of have forgotten them or don't have the workforce that's trained up on them now. So you're kind of reversing back up that learning curve and figuring out how to implement these appropriately, and then also getting the government policy in a place that makes it more feasible to, especially on the large scale side, get these in place.
I think that's a great thing to mention, because that's been such a hurdle for the few that we have produced, and getting that clear, concise, and obviously it's important. Nuclear reactors can, need some amount of regulation safety, but if you can get that in a place where it's not changing every few years and you're not having to go rebuild portions because the regulations changed, that'll do a lot. And it was very encouraging to see some progress that way in 2025, which I think will help set us up going forward.
Right.
Sorry to.
Oh, no, absolutely. And I think going off of that, as we look at the nuclear space, we're less interested in investing in the direct companies involved in the nuclear build out necessarily, but certainly those that are going to benefit from just generally worldwide nuclear proliferation. And that is especially true about uranium miners. Cameco is a name that comes to mind. because there are so few uranium miners in the first place, and of course uranium is a critical input into nuclear fission and creating nuclear power, and the supply demand dynamic for uranium is looking very tight into the foreseeable future. Especially starting last year, you're starting to really diverge from demand far outpacing supply. Maybe we can throw that chart up on the screen for our listeners and our viewers. But that's a really interesting area that I think is valuable for us to be invested in because of the supply demand dynamic. I see prices going higher from here in that category as nuclear continues to build out. Of course, as you mentioned, we haven't seen quite as much building, maybe some plants that are reopening here in the United States, but certainly plenty in China that are coming online, and this continued build out interest in SMRs, like you mentioned, that are just going to continue to contribute to the demand side for uranium.
Yeah, and that's an important thing, is that it's a global market. So China producing them is just as good for Cameco or someone in that space, as the U.S. producing them, as it is if Canada produced them. And most of that mining takes place in Kazakhstan and Canada. I don't want to get too far into this, but Kazakhstani production is generally dominated by the Russians, who they take all of that mined uranium and they refine it themselves. And so with the current state of things, a lot of that isn't finding a home, at least not in the US. A lot of that is going to China. And so that leaves Western production to, fill in for Western reactors. But at the end of the day, it is a global market where no matter who's building them, and China's building them at a rapid pace, that is getting used up, and you don't have a whole lot of places where you can mine very profitably. And of course, spinning up mines takes a long time and a large amount of capex. So we're really expecting that demand supply to continue to diverge.
Yep, exactly. Then, we mentioned natural gas. I think natural gas, obviously it's been in the market. We don't need to talk at length about this, but it is very good as far as, the capacity and ability to ramp to, 24/7 power. Of course, natural gas plants do require some downtime, but you can control the power output to a large extent. Natural gas is very prevalent within the United States, so that's also a great source. And when we're thinking about these power generation, components, at least the energy inputs, we're also invested in the companies that are creating that, generating the power from that energy source. So that being turbines are a big piece of this. It's a very tight market, and the supply chain is extremely tight. Backlogs are very long. And so these companies are really going to benefit. The companies producing the turbines, producing the power generation. Also, the companies that are converting that power, just because you can generate power doesn't mean it's ready to be straight plugged into. There's a lot of power conversion steps, processes. It's very technical as far as delivering that power to the data center. We're invested in that as well. And I think all of these things also play into huge demand for another material, and that being copper. And so copper is something that we see huge supply demand imbalance. Of course, ramping up supplies is very difficult. Copper is mostly sourced from, third world countries for the most part. Of course, we do have some here in the United States, but it's not exactly easy to ramp up a copper mine the way it is to demand more copper. So all of this electricity generation creates huge copper demand, and similar to uranium, we see a huge supply demand imbalance kind of on a go forward basis because of this AI build out.
Yeah, you kind of have the same hindrance to supply for both uranium and copper, but then obviously your end uses are different, but in some cases both power generation, so can be pretty similar stories in a lot of ways. But that is an interesting one to watch. Something you mentioned on natural gas I think is important to highlight just real quickly is that you said it's easy to turn on and off. That is one of uranium and nuclear's best qualities, also worst qualities. It works really well for baseload power, but your power demand is not a straight bar across the day. Right. It ebbs and flows when people go to work, when people come home, whatever it is. So having an amount of easy on-off power is very important. I mean, right now we're just not producing enough in general, so it doesn't really matter what gets us there, but we'll always need some kind of incremental, easy on-off switch power to fill that gap.
Yep, absolutely. And so I kind of want to, start wrapping us up here, but looking at the AI ecosystem, we are still, invested in semiconductors, especially a company like NVIDIA, who's really dominating that side of the AI ecosystem, but also, companies like TSMC, ASML that are, critical to that chip generation and integral to having the most advanced chips, regardless of whether you're talking about training or inference. Those are very important. I mean, Google's another name alongside Broadcom that's emerged in that semiconductor generation piece. We really like that power demand segment. So, companies that are integral into generating that power, delivering that power. And then, of course, on the side of those inputs, we just mentioned uranium, copper, really interesting areas of the market that are very tight. And looking at all those picks and shovels as what's making up, or at least the companies that are certainly benefiting immediately from AI. We hardly talked about AI software during this conversation, and that's because I think we're still getting there for the most part. As I said earlier, we're looking at those companies that are beginning to implement AI, but we're certainly more bullish on the picks and shovels aspect than the software piece so far.
Yeah, software has been a really interesting, space with AI because AI has been making software better in a lot of ways. Some applications of AI can be a little clunky in software, Microsoft, but with Excel, it can be rough. But it's getting there for a lot of things, and it's been really helpful in Photoshop, in the process to produce these episodes. In applications like that, it can do a lot of things for you real easily, but it also lowers the barrier to entry for other firms. Just recently we saw Apple come out with their own slate of or bundled package of similar software pieces that Adobe's traditionally had. And so you see stuff like that, and so I think investors have been really apprehensive to get into the software space, not because AI is not starting to generate efficiencies, but because it's lowering those barriers, those moats that companies have built over time, and making it a lot easier to displace them, which it'll be really interesting to watch as it goes forward, because I think you'll see some real winners, but you'll also probably see some real losers.
Definitely. And that brings us full circle back to the point being that it's very important to discriminate within the AI ecosystem. You can't just, pick everything anymore, or, throw a dart at a dartboard when it comes to AI companies. It's going to continue to diverge. I think especially this year is going to be a big year for that. So we're looking for, durable trends and protected margin and margin growth, I think, are critical. If you're in too competitive of an ecosystem, without, a supply-demand imbalance where demand's outpacing supply, then margin can get really tight. And we're also looking for, lower debt and a diversified client base. I think, this ecosystem can often lend itself to being over-reliant on a certain customer or client. And so, picking the companies that have diversified opportunities, who, have that margin protection, who, of course, are continuing to grow their revenue and earnings, but being very discriminate as far as picking companies in that kind of space.
Yeah, I'm really excited for the year ahead. I think it's going to provide a lot of opportunities to do what we do best and dig into those companies. So I'm really excited to see that, especially coming after 23-24, like you said, where a lot of the AI trade was traded with a beta of 1. So
right. Absolutely. Well, if you have any questions about the AI trade, what we're looking at, what our thoughts are, drop us a comment or contact us through our website. As a little teaser, next episode we'll be talking about the Fed. We'll be talking about the macro backdrop, how we think that's going to drive markets in 2026. And Hunter, I'm excited for the next episode as well.
Yeah, me too. Should be good. Thanks, Victor.